Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I'm really excited to have with us today Aron Alexander, who is the founder and CEO at Runa. Runa is a digital value infrastructure, and it helps people pay and transfer value and connect with merchants. And so we'll talk about the types of economic activity that Runa supports and sees, which I'm really excited about. With that, Aron, welcome to the conversation.
It's a pleasure to be here. Thanks for having me on.
Fantastic. So let's get your founding story. How did you come to start this company? And what was your background before you started it? What led you into this direction?
It's quite a complicated one, so I'm going to keep it relatively short. I think Runa is this Venn diagram between different experiences I've had in my life. I was kind of fortunate enough to kind of grow up with a family that owned lots of small retail stores, groceries, bakeries, clothing stores. Kind of grew up in that environment, kind of seeing people consume everyday goods and services. I worked in payments for a bit, a B2B to C payments company when we had to integrate into retail systems and offering like a mobile payments QR code based technology before Apple Pay actually, so quite early on. I had some financial market experiences where trading foreign currencies and equities and seeing how kind of spreads work and buy sell dynamics, and worked in a few different e-commerce kind of opportunities with friends or people that asked me for advice along the way. So Runa kind of ended up being this Venn diagram between my payments, retail, financial marketplace experiences. And I think it all started because way back when I actually received a refund from a business in the form of a paper voucher. And what was interesting about it was the amount was only £5. And I was thinking about the economics of picking and packing, shipping a piece of paper for £5. And the other interesting thing was it was available to be redeemed at multiple stores. And the things that struck me about it were a payment mechanism that effectively existed outside the banking rails and credit card rails. So I didn't need a bank account to receive the money, and I could redeem it without a card. There was kind of economics involved from the merchants where they're paying fees to distribute these kind of vouchers. So the economics of paying interchange were inversed or inverted. So merchants were paying quite large fees to be part of this network. I thought if you could digitize that, you could actually solve quite a lot of problems that I saw in the payment space. And I understood retail, and I understood retail systems. So it kind of felt like a big opportunity to basically create a new network by directly integrating into merchants to facilitate the movement of value, but in a digital way that could be borderless and real time and data rich, in a way that the kind of existing card networks or banking infrastructure couldn't facilitate.
Super interesting. I want to lay down a little bit more groundwork, and I think your experiences around the retail footprint and then in the payments industry are maybe a way to open that up. From a very basic perspective, like, how do you think about commerce and the motivations that the actors have within commerce? And maybe it's super obvious, but I'd love to hear kind of your intuitions or your conclusions or your experiences for some of the more surprising or maybe profound things that, as somebody who was growing up in this family with lots of retail, like, what did you learn about how people shop, why they shop, and then how merchants provide goods and what they struggle with?
Yeah, it's an amazing question. Expansive to say the least. I think this gets to the heart of what payments and money really is. Because if we think about payments as, lots of technology and infrastructure and ledgers and counting, I guess, balances. But fundamentally, it's trying to facilitate the exchange of goods and services so people can live their daily lives. And that might sound a bit highfalutin, but fundamentally what people need is they need to consume products, they need to consume food, they need clothing to just exist. And And that might sound really simplistic, but that's not always like a straightforward thing for people, especially at the lower ends of the social economic scale. So like one of the things that I saw growing up, like in the 90s, it was only like one grocery store, right? So there's not like an empire of sorts, but we used to offer credit to people. It's like almost like a prototype of buy now, pay later, because people couldn't actually afford to buy goods and services, so could buy their groceries. So I think like to try and answer your question, people need access to these goods and services. Merchants are looking for all sorts of ways to sell, to provide, and they will do many or try many different things in order to do that. And in this case, a kind of early credit product in the 90s in the UK, completely analog, but there was a demand there from consumers, and merchants are willing to try things in order to increase their sales and to serve their customers. And so I think what you see is that consumers will go where they can get the best service. Merchants will typically try to innovate where they can. I think the biggest limitation, and this is actually a nice example of it, is the technology. Like that whole credit example was done manually, right, on a book, and people will have to be kind of followed up or like tracked and kind of reminded that money's owed, and maybe they come again and then they add it to their balance, but that balance is now in an analog book. So I think the fundamentals are consumers will seek the best service they can offer. Merchants will always try and keep up with that demand and innovate. Merchants are typically limited by the technology they have, because that's not their business. Their business is to sell, not to maybe innovate technologically. And those are kind of some of the key insights I think I have from those experiences.
And a similar question around the next layer, which is around payment systems, and maybe you mentioned credit at a store, so maybe like loyalty systems, things that get people to reduce friction to perform commerce, as well as create stickiness with them, create goodwill and stickiness and brand with a particular merchant. Like in your professional experience, what kind of things stuck out to you, like in terms of the role of payment networks, the role of these card programs or loyalty programs? Like, did you think that the incentives are aligned? Were the providers of the software and the networks doing the types of things that merchants needed? Like, what were your takeaways there?
To go back to your incentives point, we can kind of build up from this first principle that consumers need to buy and merchants want to sell as much as possible. And then the second principle that merchants are not typically set up to create better ways of selling. And this is where I guess you have these other actors coming in to provide software and other technologies to increase the way merchants can sell. And so I think the incentives are aligned insofar as like merchants, if they can see the ROI of using a new solution, will adopt it. The key thing about payments and in the retail space is if a solution can show an ROI and an added value, then merchants will try it out and will try to exploit it as much as they can, because everyone wins. And it's that win-win scenario that I think is where things really start to get interesting. I think the next kind of layer up is, now that you have these payment systems, is like, what else can you do with it? So you saw the rise of EPOS systems, more card payments in store over cash, which are a lot more efficient operationally for merchants. And then you start to see, well, what else is next? And I think, these other solutions are almost infinite in terms of adding wallets, being able to create pockets of value that can consistently drive behavior in the right way. And I think that behavioral thing is quite interesting, because you kind of get to a point where, okay, you've set your stall up, so to speak, to sell your goods and services, but how do you then drive the behavior that is most profitable to your business? And we see that actually in Runa in many different walks of life, not just in retail, but a lot of our other customers that use us to pay out. So we have a whole kind of focus on businesses that need to send small amounts of value to consumers or employees or people they serve at scale. Is very hard on the traditional banking and card networks, because they're not set up for these like micro transactions, and definitely not from business to consumer. But what a lot of our businesses do, so surveying companies that are trying to drive people to provide insights and data, or marketing platforms that want to drive consumers to buy a product or service. On both sides, we're actually seeing financial incentives to drive behavior. And I think that's like the key principle here is both merchants and other, I guess, verticals are offering consumers some kind of financial incentive to either return to store or increase their basket value or provide some insights. And you kind of see this in HR as well. Like you get a financial incentive for doing a good job, providing maybe a great delivery on a project. And all these kind of opportunities really revolve around aligning incentives, as you say. So if you do this, then I get that, and we both win. And so I think the role of technology is how do we provide, fintech in particular, how do we provide the infrastructure to allow these parties to interact and transact with each other in a more, I guess, meaningful, profitable way for everyone. And I think that's the key challenge, especially in retail, is that, that's not their business. They are not technology companies. And so the role of these other products and services is to provide the ability for them to do more with less in a way where the products and service can make money, the merchant can make more money, and the consumer gets a better experience.
I just think of that as like reducing the friction to creating economic output and GDP.
I would say that's right. I think that's one element.
The better the software systems, or you don't even have to use the word software, the better the systems that connect people who are creating and consuming and transacting and clearing, the better those systems are, the more liquid they are, the greater the potential for, for human productivity.
Right. And if I can, I love this idea of friction, because what I've learned a lot is like consumers hate friction. I was playing in the Horizon metaverse thing a few months ago. I was in a British pub. And they're like, if you want to contribute to building this pub, send us money via PayPal. And they gave the PayPal address. And I could just, go to my PayPal account and send the money. But it's friction. And I'm just not going to do it. And I think the process innovation underneath that, which what we see with APIs and with a lot of the Web3 technologies, reducing that friction is, as you say, not just creating a lot more economic growth, but it's really kind of addressing a fundamental human kind of desire to like conserve energy and make things easy.
The physics of finance.
Yeah.
The law of conservation of energy, or the maximizing lazy rewards.
I love that. Yeah.
So, okay, let me ask you then about Runa. What is Runa? What does it do? And if you could kind of paint it with numbers as well, that would be great.
Yeah. So, the fundamental insight is that we need a new way to transfer value for goods and services for a number of reasons. One, commerce is becoming more global. Current infrastructure to transfer money internationally is very expensive and slow. Two, the form factors that we have when we store value are changing. So you're seeing more currencies in gaming environments or in loyalty points or in air miles. And none of that is interoperable with the mainstream economy. And so what we're doing is like building a ledger-based infrastructure where any store of value can be moved between any party. And then most importantly, exchanged for goods and services with a merchant. So to kind of bring that down from the abstract, what we've done is we've integrated with over 2,000 merchants in 30 countries. We then allow businesses to use that platform and that network to send digital value to consumers for a refund, for remittances, for a freelancer who needs to be paid. And they can do that over our network in real time, instantly, in an automated way through our API. So I can send $10 to 10,000 people at the click of a button. And that could be, as I mentioned, for up to 40 different use cases. And those recipients receive that money in real time and then can immediately spend that balance with any merchant on our network, online or in store. And that happens completely outside the card rails or the banking networks. And what that effectively facilitates is this revolution in what we call the B2C payouts part of the payments industry, where businesses have to send these small, micro transactions, low value, high velocity payments to consumers, employees, citizens, students, freelancers at scale. And we've just provided a frictionless way of doing that. That's level one. Level two is that the format of the value can be in anything that the consumer or recipient wants. So we send $100 worth of value, but you can receive it in airtime credit. You can receive it in a subscription to Netflix. You can receive it soon. We'll be adding crypto again onto our network. We've had it before. And then all these stores of value are interoperable on our network and can be spent with a merchant. So we're solving the business to consumer payouts problem right now, which is a $20 trillion industry, We're doing that globally in 30 countries at the moment, expanding to another 30 this year. So we'll be in 60 by the end of the year. It's effectively a global network for transferring value that can be spent with merchants on our network. And then we expand from there into other payments use cases over time.
When you say you've integrated merchants, what does that mean? Are you integrated into Shopify and like e-commerce platforms, or like how does a merchant onboard, and what's the level of integration? What do they have to do to be quote unquote integrated?
Sure, that's a great question because I think, again, it unearths the kind of payments landscape in retail. Effectively, a merchant needs to recognize a payment type and have it accepted by its system. And we do that in a number of different ways. We first started building this network through closed loop stored value systems, i.e., gift cards. So we integrated into merchants' gift card system because that was the cheapest, quickest way for the merchant to recognize us as a payment type is by using their own currency. Getting integrated into a merchant alongside the likes of Visa and MasterCard is a kind of very difficult and different proposition. You kind of need scale from day one to convince a merchant to use you as a payment type, and you need a business case. So for us, it was, well, we can drive corporate spend to your stores, and we can do it in a really simple, light touch way when we integrate into the likes of First Data or Vantiv or GiveX, whichever payments or loyalty or ePOS system that the merchant has, we'll get a connection to. And then when the consumer arrives at the merchant, they simply select the merchant, enter the amount, and then we spin up a code that can be redeemed at that merchant. And that code happens to be something the merchant recognizes, which is their own gift card to start with. We're now integrating into point of sale systems. So we're more like a pay with Runa at checkout. Same with online, integrating into the checkout flow so that, you can pay with PayPal, pay with Klarna, pay with Runa. And that's the kind of evolution of our merchant network. But we've kind of found a very cheap, quick way of doing it through typically gift card systems. And all the merchant needs to do is contact us. We already have integrations into almost all the key kind of back-end systems. So it's a matter of doing a quick project and we call it a config with their third-party provider. We do all the heavy lifting. It's really straightforward.
What's the industry structure of the third-party providers in the gift card system world? Like, is it pretty concentrated with a couple of really large ones, or are there lots of different ones? And then how does the geographic footprint play into that?
Yeah, so it's a complex, fragmented landscape. I guess the core or the bigger merchants are on typically the bigger systems like the First Datas of the world, the Fiserv, obviously, Vantiv, WorldPay. Though there's a concentration of like key merchants with those businesses, the complexity is actually getting integrated into those, and you need the merchant to sign off on it every time. So there's still, even though there's concentration there, it's not a kind of one and done dynamic where you get integrated and suddenly you have access to everything. You need to onboard all those larger merchants. On the, let's call the middle of the market or the long tail, it's usually kind of managed by the POS providers, Lightspeed, I guess Shopify for online, where you need to kind of, there are no like out of the box open, none of these systems are open, I should say, but especially in the middle of the market, there are no kind of set up programs or gift card options for medium sized retailers. So there we're going into the checkout flow at point of sale itself. Similar kind of process, but different mechanism. And then for the long tail, it's even more fragmented. And sometimes you need to even, we're looking at providing micro point of sale systems or virtual ones to small retailers who don't have almost any infrastructure. I guess that's how you could think about it, is that the head of the market, you can typically go to the large payment processors who will have some kind of module that serves the Starbucks of the world and get access that way, although it takes years. In the middle of the market is more point of sale, and then the end of the market, you need to be a bit more creative to get retailers to recognize and accept what you're issuing. So it's an aggregation of a very complex payments kind of landscape from a either stored value or mainstream payment system.
Yeah, so it's almost like an embedded finance for this particular part of the large payment processor capabilities, right? So you're transforming those systems into an API layer that can be accessed much more quickly. Why did you choose to go in the sort of like cover any geography route rather than picking a corridor and going really deep? Because I imagine it takes quite a bit of headcount to dedicate to keeping those connections live and working. And so, like, the broader you are geographically, the more difficult it becomes.
Yeah, so it's an interesting part of our journey. I was kind of inspired by an entrepreneur that I was at an event with who was from Ireland and said, being from a smaller European country, you kind of have to think global first. And that kind of prompted me to talk to our customers and understand their needs more and kind of understand that actually a lot of the payouts use cases that they are trying to solve for are cross-border. So to make it very simple, if I'm an HR system and I'm serving a business and I want to provide them with some kind of reward for peer-to-peer recognition or manager recognition, the 30 people in Bulgaria are just as important as the 500 in Texas. And so you need to be able to provide a payment method that is as easy to use in both markets. Same for freelancers. We work with a lot of companies or in the affiliate space where those influencers are across 30 or 40 different territories, or they're working with gig economy workers who are writing content across different countries. And it's really a big part of our value proposition that we're making money as easy to send as sending an email. It's over the internet. It's very simple for our customers to send money anywhere. Then the other half of your question is, well, isn't that quite difficult and costly on the back end? Fortunately, this is all API driven. So we're able to make integrations and connections from our UK headquarters. We have been able to hire in key markets to maintain those merchant relationships, which is, I guess, a key part of our value proposition. But ultimately, we've been able to scale because the more volume we've been able to attract and the customers paying through us, the more merchants want to join the network, which in turn attracts more customers, which in turn gives us more volume. So that flywheel has enabled us to scale internationally. And we've made it relatively cheap for us because we've thought about it from day one. So very early on, we built multi-language, multi-currency invoices where in Germany, it's not a decimal point, it's a comma. Thinking about that by design has made it a much more scalable and viable kind of offering and makes it very differentiating and unique for our customers that there's a global network that they can access instantly that solves all their payouts problems wherever the people they need to serve are.
You can never get it 100%. Like, it's just impossible, and so I think you start getting into kind of compromises, right, about whether it's shallow but long tail but super deep in a particular corridor. But I think that as more and more of these systems become API first and get digitized, it does become easier. I do want to also double click on just understanding what you mean by value and how you do the transfers. Again, I think like there's payments businesses, there are networks, there are neobanks, and they all kind of say similar things but do very different things underneath. So like when I think about cross-border money movement, I think about either the existing banking system, which we know has friction, although not as bad as people make out to be. I think about the crypto rails, which have gas fees and so on, but struggle with on and off ramps at the edges to actually be geographically anchored. And then I think about companies that have taken approaches like opening up a bunch of bank accounts in different geographies and then internally balancing out those values and kind of taking on the FX risk, right? So if you look at TransferWise or Payoneer back in the day, or lots of the sort of like cross-border payments stuff, you basically have omnibus accounts that the payments company runs in all the geographies where they're present. And so you get an instant transfer because the company is taking kind of on that risk rather than waiting for the money to move. The money doesn't move. It just, you have different buckets and then you reconcile at the end of the day. What's the infrastructure for you in money movement? What's the role you play? Like, what's the risk you're taking on? What do your partners do? Can you talk about the mechanism of that?
Sure, yeah. Just listening to you speak, it kind of reminds me of the kind of aphorism in science: you need to understand the world, and in business, you need others to misunderstand it. And I think there's a lot of misunderstanding about how different players are participating in the market. I think for us, the mechanisms where we kind of transfer value are we receive money, fiat money, via bank transfer in bulk from a business. So let's just say they put $100,000 through one of our local bank accounts. We then have the ability to enable that business to virtually represent that value on our network, kind of like PayPal, I guess. So let's send $100 to 1,000 people wherever they are in the world. Now, the next complication is the FX side. So then we enable the transfer of FX on our network now through integration with one of the providers, infrastructure as a service, where we effectively handle the money conversion into different currencies. The recipient then receives that value, they walk into a merchant and they spend. That entire transaction so far has only been represented virtually. The actual cash has not moved in any way. So once the spend happens at the merchant, we then owe the merchant money and we settle to them every, depending on the relationship, 7 to 14 to 30 days. So it's kind of like the TransferWise model, I guess, as you described, where you have these omnibus accounts in different markets, and then we bulk settle the money. But the innovation here is that all those microtransactions happen on the network for free, but the cash movement happens in wholesale bulk in a batch process, every 7 to 14 days, which is a lot more efficient.
And it happens for free on the network because the currency is these reward cards that are an obligation of yours to the merchant. And so you're kind of just splitting the rewards currency.
So if we kind of abstract away the rewards part, just think about the recipient receiving $100 and then being able to go into a store and spend it. At the very last second when they want to spend, we convert that money, the dollar, into the merchant's gift card just in time at the point of redemption or spend, so that the merchant can recognize us. The gift card in and of itself is kind of trivial to the financial movement of money, if you like. It's just the mechanism to talk to the retail system so that the person behind the point of sale can recognize the transaction, is authorized, and release the goods.
How is the international bit handled? So when you settle on that periodic basis, the 7 or 14 days, have you already set it up so that the bank account is in the same geography as the merchant, or is it that you're wiring to the merchant, or you're doing an electronic transfer or something?
So to answer the part around why it's free to move, because the network is something that we wholly own. So unlike if you made a parallel with the payments networks, that there's no gateways or processors or issuing banks or network partner, it's effectively free for us to move that value virtually. We get paid by the merchant for driving traffic and driving spend to their stores, which is how the economics work. And then on the settlement side, to answer your second question, we have local bank accounts in many of the countries, not all of them, that we work in. And then we do a transfer between our bank accounts. So we work with HSBC, our UK and US account will transfer money between one and the other, and then we'll settle to the merchant through a local account, which is much cheaper to do.
Gotcha. So when you say the network, you're able to hold money in different geographies, and you're essentially just reconciling your own books between those different geographies.
And between the books of the merchant in terms of what we owe them.
Right. And the payouts that you need to. Okay. Can you give a sense of the scale in terms of volumes or the number of transactions or the number of end consumers?
Yeah, so by the end of this year, which is fast approaching, we will have had over 22 million people redeem through our network, spend through our network across those 30 countries. This year alone, we'll be issuing over $1 billion in payouts across those 2,000 merchants we have and growing at quite a clip. The average transaction amount is something like $45, relatively small amounts. And the businesses we are working with are typically saving roughly 4% on every transaction. So when they make a payout of $100, they're typically only settling money of $96 to us. So they're saving money. The merchants are seeing an incremental spend in store of about 30%. So when that $100 is sent to a consumer and they spend it with a merchant, they're typically overspending by another $30. And so everyone's really winning here. The businesses are paying out in a frictionless, real-time way that costs them less than the face value of the payment, because we share in the economics with our customers. The merchants are paying for a consumer to go spend with them and getting a 30% overspend. So they're happy to pay quite rich fees to get that business. And the consumers are receiving their money as opposed to waiting 5 days, or in some cases having to pay a €25 bank fee on a €50 payout. They're receiving money immediately for free that they can immediately spend online in store with every merchant they care about.
Of those 22 million people, is there a use case or maybe a merchant that's like your best customer? And I don't mean necessarily like, who is it and what do they do, but what's their shape? Like, what's the best go-to-market and product market fit that you've hit here?
A few different answers there. So we actually, fortunately, do not have a concentration on the merchant side. And the typical first question is, well, isn't it all Amazon? And thankfully, Amazon represent a single-digit percentage of our overall network spend, which is great for our consumers and our customers, where the utility of the network is such that people spend in many different retail stores for many different reasons. And there's no concentration there. On the business side, where we've been really successful is you can kind of think of us as like the Twilio for payouts, where there are 30 different payouts use cases, let's say, and there are different vertical specific software solutions for each one of those use cases. So there's a software for loyalty, software for marketing, software for surveys, refunds, affiliate payouts, etc. And those software businesses are selling to other companies to solve those problems and plugging us in as the way or the mechanism to make that payout in real time on demand. And so, fortunately, we don't have a concentration of verticals either. We have our ideal customer is a software business looking to solve one of these vertical specific use cases through their software, within which we are the payout mechanism. And let's say that the top, they're quite evenly distributed between the following 7 use cases, which are loyalty, points conversion into cash, HR, reward and recognition software businesses, plugging us in to enable the companies they sell to have employee reward and recognition, marketing for referral and acquisition, survey incentives, affiliate payouts, so influencer payouts, refunds, and then we work with a lot of actual reward platforms or incentive APIs that use us as their engine to pay out with.
Super interesting. I know you've said this, but it's finally kind of landing, which is like an embedded finance layer for business to consumer payouts. And there's lots of versions of business to consumer payouts or business, like a company to a human, whether it's through commerce or whether it's through HR, and also in a cross-border type of environment.
And the innovation is that the value that's being transferred is accepted at the merchant without having to go through the traditional incumbent infrastructure of card or banking networks. It's a real direct one-to-one kind of transaction, which happens on our network.
I have 2 questions. One is around the economics and one is around the types of value transfer. Maybe let's do the question around economics first. How do you grow? How are you structured? What are the incentives that you're trying to set up? And, what are the revenue pools that you're going after?
Sure. Yeah, I think in terms of understanding how the current payments market works and how we disrupt there, it's kind of like the idea of to understand how something works, you have to figure out how to break it. And I think we've kind of broken the traditional kind of method or economic incentive structure that people have in payments where it's very high interchange and everyone's trying to get a slice of that. And it's the principal $100 you're sending plus the interchange that's costing the sender and the merchant and everyone in between is trying to take their slice. What we've done is we've proven to our merchant partners that this is a incremental growth channel that's highly profitable. And so they're willing to pay us fees of, let's say, up to 10% to get access to that channel. And then we're showing our customers, yes, this isn't a Visa or MasterCard type product yet, although over time, the more merchants we add, the more utility we'll give you. But as a payment method, when you're sending $100, you may only be paying 95. So we're saving you money when you're sending money. So that becomes quite attractive for both parties now because we're allowing everyone to share in the economics. And the flywheel there is, the more volume we can push to our merchant partners and the more incremental profitability is for those merchant partners. So new use cases, new consumers, more data on the transaction, more transactions from new markets or new businesses. The more we can drive that to the merchant, the more they're willing to pay us. The more they're willing to pay us, the more we can share with our customers. The more we share with our customers, the more volume they'll drive towards us. So we believe in like win-win economic and incentive dynamics. And I think that's what we built here. And it kind of really, as I mentioned earlier, inverts or breaks the kind of current way payments work.
In the case of sending £100 for 95, why is that? Is it that a merchant is willing to sell 100 for 95 because the person that's showing up with that 100 is actually spending once they get into the store. So it's, there's additional,
They're spending 130.
they're spending 130. And so on average, a merchant is willing to underwrite that kind of instrument.
Exactly, because as soon as the value is transferred to the merchant's currency, in this case, they have a locked in consumer, and that consumer is going to spend the amount plus, as I mentioned, the overspend of 30%. So it's highly profitable way for merchants to drive either acquisition or overspend by consumers. And if it makes money, it makes sense.
And so you're taking a portion of that £5?
Yeah, so the merchant might give us 6 or 7, depending on the relationship and the commercial terms, and then we will pass on and share in whatever fee we get with our customers.
Cool. Okay, that makes sense. As a last question, I wanted to explore your relationship with other forms of value. So I see that on your site you say equity shares are a potential value, cryptocurrencies are a potential value. There's obviously stuff like NFTs. How do you think about that packaging, and what role does it play in your business?
Yeah, I think what's really interesting is this kind of unbundling of this what is money. Money is a store of value and it's a medium of exchange. And we've kind of now come up with all sorts of different ways of storing value, which used to be analog. So there's not much you can do with them other than the purpose that they had when were minted. So when you issue some shares, they're just ownership in a company. It's a piece of paper. You can buy it or sell it. Once these stores of value become digital, it starts to get really interesting because they all effectively become zeros and ones on a ledger. And they can all then be interoperable and interchangeable. So what we've done is, I'll give a quick example. We worked with Coinbase in 2018. We allowed Coinbase wallet holders who at the time wanted to get off-ramp back into fiat would take 5 days. And at that time would cost them about 3%. We allowed them to spend their crypto assets on goods and services on the Runa network to buy a cup of coffee or get a cab in real time for no fees. And we gave them a bonus of 5%. So we shared the economics with them that we were getting from the merchants. And so the implication of that is like any store of value becomes interoperable with any merchant anywhere, and anything can become money. And I think it's like this notion of ideas become interesting when you start to get scared of the logical conclusion that they take you to, which is, in this case, any asset that you have that is deemed to be worth something, if it's digital and there's a market for it, we can provide liquidity for that asset and enable it to become a means of exchange for goods and services, whereby we're an on-ramp and off-ramp between that asset type, cryptocurrency, fractional shares, airtime credit, and fiat, which is what the merchant really wants at the end of the day. So the network really becomes this infrastructure for transferring asset types and the underlying value of those asset types into different formats, depending on what the consumer wants. So they want, they're on a gaming site and they're playing it through their phone in Southeast Asia and they need to top up their airtime credit. They can do that. Or they want to receive the money they have owed to them in cryptocurrency, but then in 6 months they want to buy something with that, pay their bill with it. We can transfer the value from one format to the other in such a way that provides frictionless movement of value to enable more commerce to happen.
Gotcha. So is the key there that, maybe like unlike some other networks, you're willing to accept crypto assets or other, let's say, more alternative assets because you have a way of connecting into the brokers that exchange that into fiat, and you're able to not hedge out, but you're able to get rid of the FX risk immediately, and you're just able to recognize that you have ways to not hold these assets and get rid of the volatility.
That's right, because everything is just in time, on demand movement of value. So there's no real counterparty risk because when the transaction needs to happen, we connect the different parties with each other, in this case, like a crypto exchange or a share trading exchange, so that the order, if you want to think of it that way, can be executed in real time. And there's no actual risk involved from our side because we're just connecting two different parties with each other.
One of the things that kind of stood in the way of using crypto assets in commerce was that volatility risk. Like even like a merchant just doesn't want to hold Bitcoin inventory or even stablecoin inventory and figure out how to go back into fiat. Did you find it difficult to get rid of the volatility? Like, is there, a delay between, whatever it is, the 2 minutes during which the transaction has to settle and you're selling the Bitcoin through some programmatic broker? Like, how difficult is that?
We found a way of taking out all the risk. So the merchant only ever received fiat. They never received cryptocurrency. The consumer would be given a price in real time, and which would update every 10 seconds. So if they didn't execute the order, a new price would be given to manage the volatility. Sometimes you have to put a small spread in there to make sure that you're not caught out by a big swing. But 99.9 times it was never an issue because of that buffer we put in, because of the real time 10-second refresh, and because we always settle fiat to the merchant for the goods and services.
I think it's a fantastic piece of infrastructure, and I certainly hope that an increasingly larger proportion of your business ends up coming from Web3. For our audience who want to learn more about you and about the company, where should they go?
You should go to Runa.io. Our team are providing a whole bunch of interesting research ideas on there. Follow us on LinkedIn and Twitter. And those will be the kind of key ways to stay up to date. Or feel free to reach out to us, Aron, Aron, at Runa.io. Happy to talk to people who are interested in jamming about payments.
Fantastic. Aron, thank you so much for joining us today.
My pleasure. Thanks for having me.
Hi, everyone. That's it for this week's episode of the Fintech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.